Hey everyone, thanks for spending some time with us today. We are 2 months into the year almost, and we haven't done a big update about how things went last year, how things are going this year, and all of a sudden we're staring down Leap Day this week. So I'm here with Andy Reynolds, our COO, John Boardman, our CEO, and I'm Cameron Hamilton. I'll be playing World's Greatest Moderator, just talking about how things are going, some topics we've been focusing on with our clients. So let's just go ahead and start out, guys, talking about how the market did last year, what we're seeing this year, just some trends, what themes are we thinking about?
Yeah, I think most clients are pleasantly surprised with how 2023 performed. Mm-hmm. And I think a lot of that is to do with how that occurred. We basically had the Federal Reserve come out in October, I guess, yeah. And at least start to lean on the idea that we would be cutting in 2024, and I think that came out a little bit more dovish than what a lot of people expected. The net result of that was really a lot more market breadth, where you had a lot of the areas, the market, small cap, mid cap, areas that had not really participated in 23 do quite well to finish the year strong. That has paused to some degree. The inflation number that came in at the beginning of the year, I think, spooked the market a little bit, and the number of cuts that are expected this year has been priced down to about 75 basis points, so call it 325 basis point cuts.
Yeah, down from about half of what some expectations were early in the year.
Yeah, I think 1.5% overall, mm-hmm. The Fed funds rate was the expectation. So, it's been, every market environment's unique. 2023 had a huge percentage of the market performance attributable to a handful of stocks in the tech space, which is fine because that is where a lot of the sales growth that we saw and earnings growth that occurred happened in those names. But to have a sort of a long-term healthy bull market, we need that breadth to continue to expand outward. And that really is the big question, I think, for the rest of this year is how will those 7 names do? They have huge expectations built in, NVIDIA being the primary one that has just done amazingly well, but also with that comes a lot of expectations within that name. So I think every quarterly report around those names will be really important. What I think we need to be paying attention to are the other 493 though, and just to see that those are actually seeing kind of the beginnings of a sort of recovery in their business, because they really haven't seen the earnings growth.
And I think there's big opportunities there. When you look at those magnificent 7 names, they are priced to almost perfection. They really need to do what everyone's expecting to do, or they're very well positioned to have some trouble ahead of them. So can we get the market breadth? And if you're a disciplined investor, this is what we joked about back in COVID, we were looking at some of these valuations. We're like, okay, something has to happen, or valuations just don't matter anymore.
That's right.
And over the long term, valuations will matter. So when you start looking at all 500 or all 1,000 or all 2,000 names, there's some names in there that look really, really interesting. Brian wrote about it in the commentary, Tina.
Right.
With basically, there's no other alternative. Nowadays there are, and we're positioned in the equity markets where there are things that look really appetizing, but also in the bond markets. There are bond prices that look good. There's yields that are starting to be a lot more pleasant for any fixed income investor. Looking at money markets, CDs, treasuries, we're getting some yields there. So I think it's really important that we do see the breadth that you're talking about return back to the market, and some of those names are positioned really well. But it's also important to look outside of equities for returns, where for decade and a half, it was really, we had to be forced into equities to see real returns. And now with a 5.25 money market, 3%-ish inflation, that's a 2% real return, which we haven't had in quite some time. And then really not even talking about outside the U.S., which I think there's a big opportunity there. So share with everybody the chart you were talking about earlier.
Yeah, we were just going through a chart earlier that was just talking about historic valuations on domestic markets versus international market's sort of a blend of developed and emerging, and if you believe in mean reversion, when things sort of get, off out of whack, that things will come back into their historic norm. International valuations are, and domestic valuations are about 2.5 standard deviations from the norm. And that goes back to 1971, so we're talking about over 50 years. So either something has fundamentally changed, that measure is no longer important, or we are sitting in a place where international markets are just abnormally cheap and basically a good price, to buy versus domestic markets. What's interesting on top of that is that in the European economy specifically, and we've also seen in the Japanese economy, you've actually seen some of that market breadth and actually earnings performance from some of the value sectors that we have not yet seen in the States. So there are, some people are hypothesizing that we could end up with, and it's not uncommon that we would have the international markets preceding our own, market performance. So I just think watching, the industrials and some of the boring areas of the economy outside of tech to see if they follow suit with how the European markets have done, I think that's an exciting time because fundamentals seem to matter more than they have in a while in the way that the markets are behaving, and that should reward them well.
Yeah, and they really should matter. It's fun to, if you look at someone who maybe has been investing for 10 years, 15 years, it's been a kind of fun ride for these big, large cap growth names that maybe you're surrounded by in your daily living. But when you start looking at fundamentals, there's a big opportunity for value and for non-U.S. Especially if rates do start to come down. You look at, some people invest in value names for the dividend, and you look at, okay, I can own a dividend of equity or I can own a U.S. Treasury. Well, the U.S. Treasury is probably going to outweigh the equity if you're investing for the income. When Treasuries come down, which at some point they will, and valuations and value stocks look good, and the yield may be more appetizing than a Treasury, there's some definite momentum that could quickly swing in either one of those two different ways.
Yeah, I think that's going to be a huge theme this year is what the path of interest rates look like, and let's talk about how inflation affects that and what we feel like we're seeing, expectations, how they've changed over time.
I mean, inflation's down to 3.1. If you look at the CPI, which is a drastic improvement from where it peaked at about 9, and that was temporary. The Fed's really, I think, been a bit fortunate that inflation's come down so quickly. I don't think people expected it to occur so quickly, but we've seen it sort of stick in that 3-ish% range for several months now. With that, they have that target of 2, and it appears that interest rate decisions are going to be largely based on their ability to get down to 2. So I think that's what a lot of economists are curious about, is that are we at a sort of a new normal? Is 3% potentially more of a baseline number that they need to be basing their expectations off of? But it's been good for the consumer that prices have stopped accelerating, but they are still at an elevated level. That just means they're not growing quite as quickly as they were before. So it's been impactful, to the consumer, and you see that in credit card balances and delinquencies, that there are issues out there with the consumer, but we also have a really strong job market. So it's an odd combination of sort of economic data right now. And you also see corporate layoffs, but jobs continuing to grow. So it's a weird sort of nebulous place, I think, where we sit.
I think I wrote down the word transitory. Anybody who followed the Fed, that was a very popular word a couple of years ago. But I think there was some transitory inflation, and it was longer than maybe the couple months that people were hoping for that definition of transitory. But supply chain inflation there's still some issues there, but the big bulk of things have been dealt with. But this inflation, the Fed wants to get inflation down to 2%. We've kind of been stuck around this 3%. So, the big in our area of what we've watched, the big discussion is over inflation and then rates. Can we lower rates if inflation is not coming down and is there reflation, inflation going back up. Those two are really going hand in hand, and Jerome Powell is very adamant on not lowering too soon. He was on 60 Minutes a month ago or so, and I think he's willing to walk the fine line of holding on for too long, knowing that it could lead the economy into places we don't want to be, versus the alternative of letting up on the rates too soon. The consumer, you kind of mentioned the consumer. I've talked to a lot of clients about this, and I think the big question is with the economy, are we slowing? And there's big concerns over 2023, there'd be this big recession. 2024, there's going to be this recession. Those words have largely diminished in the media. But I think the big debate is, are we a slowing economy and we will continue to slow, or are we a more normalizing economy? And still knowing that the world looks different than it did 5 years ago, and we're not going back to that. There are new jobs that have been created that, influencers, social media, those jobs probably aren't going away, and that's different. So I think there's still a big debate on. Data looks really good. We're starting to see a couple weird things with the consumer. 90-day delinquencies on a couple of things have gone up pretty drastically quarter over quarter, but historically not incredibly high. But that trend is eye-opening, something to be looking at. But I think the biggest debate is, are we slowing and continuing to slow, or are we just normalizing, trying to figure out what the new economy looks like?
Yeah, I think the interesting thing about the backdrop right now is that housing has slowed, but home prices are not falling. I think you've seen some weakness in some of the hotter areas, and jobs are still readily attainable. And so those two aspects of someone's personal life tend to sort of dictate their optimism or pessimism on the world and opportunity. So we've had this backdrop where the Fed was essentially trying to sort of throw pain at the economy and the consumer and businesses to slow it down. But those two aspects of it have sort of held their own even against that. It's been a fascinating environment. Now, we could see, some of those things happen sort of in a lagging manner where we don't necessarily see them on the front end. But I think that has, when I say the Fed's been lucky, fortunate, I think they were strategic, but I think the fact that those two aspects of people's personal lives have maintained their strength has allowed them to cool the lending environment, so to speak, and slow down the money supply acceleration. They keep the consumer relatively formidable. I mean, we see those issues with delinquencies and credit card balances, but consumption, through the end of 23 was still relatively strong.
Right. And they weren't higher than if you zoom out 10 years. No. They're still relatively low to a historical level. It's just, where are we going next? I will say, working with clients and hearing from clients, it does sound like there's more, there was a lot of COVID money in the economy and people spending and pent-up demand, and then I think all that was done, and then kind of the fall over from that into the next year, and people kind of kept this pace. I think I've seen with clients and just observationally out and about, it seems like people are looking in the mirror a little bit more, and just not necessarily I'm forced to stop spending, but more of, okay, we've had a couple of years of this really fun stuff. We did the house renovation. We bought the cars that were ungodly expensive. Now it's just more of trying to get back to some type of discipline. And I think that's healthy. That's what we need. We need a good economy is one that ebbs and flows up and down, but our highs aren't too high, our lows aren't too low. And if the consumer can have a little bit of self-reflection, we are a consumer-based economy, so we need to spend, but not spend too much and not get too low. I mean, that is the soft landing that everyone's hoping for.
And I think businesses are doing the same. I mean, I think the corporate layoffs, which you tend to see, after some type of an economic slowdown, I think a lot of these businesses are just leaning up, for lack of a better phrase, and that, although terrible for the people that, you know, have lost their job. What tends to follow that is, particularly if the economy shows improvement, if we end up sort of easing monetary policy, that many of those companies will be prepared to be more profitable in the sort of the next chapter, you know, when we get to that environment.
And I do think if there is a recession, if there is, which there will be at some point, but if there is in the near future, or if there is this big economic slowdown, this has to be one of the most anticipated and prepared for economic slowdowns in history. So, not that it won't happen, very well could, and there's definitely some changes underlying the economy, but I don't know a single person who's not thinking about this or anticipating, and there may be a storm underneath that we don't know yet, but it's typically the surprises that get us, not the anticipated things that we're trying adamantly to deal with.
Yeah, I mean, like the banking crisis last year with Silicon Valley, I mean, that was, in hindsight, seems obvious. You raise interest rates, that you're going to have people take hits on their fixed income portfolios. I don't think that anyone predicted that as being an acute issue that could potentially have a ripple effect, you know, through the entire banking environment. So when you make drastic change, which the rate of increase was so swift, it's hard to not expect something to break. I think the fortunate thing, knock on wood, is that so far that's been really the major crisis that this economy's had to face, you know, in that tightening environment.
Yeah, and just having rates higher for longer being the expectation now, with, you know, the idea that some people came into this year thinking we could have 1.5% down on the policy rate. Now maybe expectations are half that. That's been the big governor on a lot of this economic activity. But what happens if we do see the Fed say, okay, we feel like the medicine has run its course, but we haven't increased unemployment, so now we can lower rates? What does that do with activity and cash that's out there right now?
It's a really good question. You know, I think and it depends on the banker you talk to. I mean, I think the banking environment's been challenged because people are just not accustomed to these borrowing rates. So I think that's just naturally going to slow activity. So I would think that would help stimulate a little bit of economic activity. What's ironic about that is that higher rates tend to be better for banks because they can increase their spread between deposits and loans. But the problem is short-term rates are higher than the intermediate-term rates, so they're having to pay a lot on cash. So rates coming down at a normalized rate curve, where short-term rates are lower than longer-term rates, I think that would be really conducive to a nice, you know, backdrop for several years potentially. We've been in this inverted environment for a while, and it's goofy. It causes a lot of strange behavior. So money that's gone into short-term treasuries, as an example, where is that going to find itself? As you were mentioning with the dividends, you know, trailing those, right? I mean, I think the dividends on a lot of value stocks are paying in the 2.5 range. Right. Well, if you can get 4.5% on a fixed treasury, might be short-term, right, but it's hard to not take that opportunity. I think you're seeing a lot of that.
I think there is a lot of behavioral finance and mental accounting that is being done right now with rates and, you know, borrowing costs. You know, I was talking with a client who they're looking at doing a $300,000 home renovation. They're going to put $200,000 in cash and borrow $100,000, and they're like, well, I'm not doing that for 8%.
Yeah.
And so, you know, materially over their life, if it's 8 or if it's 4, doesn't matter, probably not. But the mental accounting of just kind of pumping the brakes with where rates are now, you know, talk to people who want to move, but they're waiting for rates to come down to start looking. So I think there could be economic activity that really picks up, which may ultimately, is that good or bad? You know, what does that do to the housing market? What does it do to inflation? I think that's something the Fed is really thinking about and looking at. Not that they have any insight really that we don't have, but I think that's a big risk to the reinflation, to inflation going back up after, you know, it's come down. We thought we were out of the woods, and then all of a sudden, you know, it goes. I mean, there's a lot of cash on the sidelines, personal and businesses, and business, you know, investment has slowed as well. So I think both of those you could see a quick reinfusion.
Right.
Of capital.
Right. Yeah, and so you're talking about treasuries, and I personally have a lot more clients holding those right now than we did a year ago. So that's one thing I'm going to be focusing on with my clients this year, is just over the decisions we've made to try to take advantage of some opportunities over the last year. How do we need to be thinking about those as we think about their cash flow and what they're trying to do long term right now? So that's my takeaway that I'm thinking with people a lot right now. Do our clients need to be focusing on as we wrap up here?
I think just discipline. I mean, I think it's easy to chase what was great last year and just remain disciplined. And I think, diversification, although it doesn't work in every year, I think it feels like we're stepping in an environment where some of these other asset classes have a real opportunity to perform. So I think consistency, discipline, unemotional decision making, that goes a long way. And I think environments like we come out of can coach people away from that. So I think that's a big part of what I think we all need to be encouraging our clients to do.
No, I agree. And my word was intentionality.
Yeah.
It's been an interesting couple of years. 2022 wasn't fun post-COVID, and the markets did well. 2023 was great. I think looking at year-end statements and feeling like, oh, things are good, things are back, we're good, let's move on, we'll see you next year. I think just intentionality around what you're doing, looking for opportunities to make yields on low-risk assets. Make sure you have enough low-risk assets for near-term liquidity. Being disciplined with what you're trying to do. I think in today's world, it's sometimes easy to get distracted with other parts of life, and life's going by fast. So just intentionally try and figure out what do you need to accomplish, and then what do we need to do to get that done. And lean on us. That's what we're here for. I mean, there's no conversation we don't enjoy. So call us with anything you have, any questions, thoughts, concerns. Involve us early. I always feel like we can provide the best guidance the earlier we get involved in things.
Right. I think that's a great way to wrap it up is, here's how we're thinking, and if anything made a light bulb go off in your head, just give us a shout. Thanks for spending some time with us today.